A lot of people don't start investing because they feel like they've already missed the boat. They tell themselves things like, I should have started in my 20s. I don't earn enough. What if I mess it up? So they stay on the sidelines for years, even when they know that leaving everything in cash probably isn't the answer either. If that sounds like you, this video is for you. Welcome to Money for People. My name is Derek, and here we explain money and investing in plain English so normal people can actually understand it. In earlier videos, we've talked about what investing is, what risk is, what a stock is, how inflation works, and what an index fund is. In this video, we'll put some of that together and talk about what to sort out before you invest, how to think about your own risk comfort, what people actually invest in simple terms, and a calm, step-by-step way to get started. This is for education only, not financial advice. I'm not telling you what you personally should buy. I'm just giving you a way to think about it. Let's start with what to get in place before you even touch investing. Part 1. Before you invest, foundations. Before you think about funds and stock markets, it helps to split your money into two buckets in your head. Bucket 1, short-term life money. Bucket 2, long-term future money. Short-term life money is for things like bills and everyday spending, a small emergency buffer, anything you know you'll need within the next few years. This is money that has a job to do soon. It needs to be safe and easy to get to. For most people, that usually means a straightforward savings account or similar. Long-term future money is different. This is money you don't need for many years. Think 5, 10, 20 years or more. This is the money that investing is usually for. Because in the short term, investments can move around a lot. But over longer periods, you have more time to ride out the bumps. Alongside that, it's important to think about high-interest debt. If you have very expensive debt, for example, credit cards with high interest rates, it's often worth focusing on that first, or at least having a clear plan to deal with it. There's not much point hoping for a 7% investment return if you're paying 20% on a card balance for years. You don't have to be completely debt-free to ever invest, but it's sensible to know what you owe, what interest rate you're paying, and roughly how you're going to bring it down over time. So before you invest, ask yourself, do I have at least a small buffer for emergencies? Do I know which money is short-term and which is long-term? Do I understand my debts and the interest on them? You don't need everything to be perfect. You just need enough stability that you're not investing money you might desperately need next month. Once those foundations are roughly in place, the next step is understanding your own comfort with risk. Part 2. How much risk can you handle? Investing always involves risk. There is no version where returns are guaranteed. But not everyone needs or wants the same level of risk. Two people can look at the same graph and feel completely different things. One might think, great, long-term opportunity. The other might think, nope, that makes me feel sick. Neither reaction is wrong. A simple way to think about your own risk comfort is to ask a few questions. First, how would you feel if your investments dropped by 20% in a bad year? Would you panic and want to sell everything immediately? Would you be uncomfortable but able to leave it alone? Or would you see it as part of the process, as long as the plan still makes sense? Second, how stable is your income and life situation? If your job or income is very up and down, you may not want your investments to be extremely volatile as well. If your situation is steadier, you might be able to tolerate a bit more movement in your investments. Third, how long are you realistically investing for? Money you might need in 2 or 3 years usually shouldn't be in very risky investments. Money you won't need for 10, 20, or more years can often afford to ride out more ups and downs. The key point is this: it's okay to be cautious. You don't have to chase the highest possible returns. You don't have to copy what strangers are doing on the internet. The right level of risk is one that you understand, you can sleep at night with, and you can stick with even when markets wobble. Once you've thought about your foundations and your risk comfort, the next question is, what are you actually going to invest in? Part 3. What are people actually investing in? In earlier videos, we talked about stocks and about index funds. A lot of normal investors don't go around picking individual shares. Instead, they use funds, especially index funds, that spread their money across lots of companies at once. The idea is simple. Instead of trying to guess which single company will do best, you own a small piece of many companies at the same time. If one company has a terrible year, it's only a tiny piece of your overall investment. If you imagine the shopping trolley analogy from earlier videos, a broad index fund is like a big basket filled with slices of many different businesses, often spread across countries and sectors. For many beginners, the types of things you'll hear about are broad stock market index funds, sometimes global funds that own companies from many countries, sometimes more focused funds like UK only or US only. The important ideas are diversification, not putting all your eggs in one basket, costs, knowing what ongoing fees you're paying, and time, remembering this is usually for many years, not months. In the UK, people often hold investments through things like workplace pensions or personal pensions, and sometimes through accounts like stocks and shares ISAs. The details and tax rules depend on your situation, and that's where proper advice or your own research becomes important. In this video, we're not saying buy this exact thing. We're just giving you the shape of what many people use. Broad, diversified funds, often index funds, held for the long term. So if that's roughly what people invest in, how do you actually get started in practice? Part 4. A simple way to get started. Let's walk through a calm, simple starting process. Step 1. Get clear on your goal and time frame. Are you investing for something in 10 or 20 years' time? Is it for retirement or just future me in general? The clearer you are about the time frame, the easier it is to keep short-term noise in perspective. Step 2. Decide roughly how much you can put aside regularly. This doesn't have to be huge. It might be £50 a month, or £100 or more, depending on your situation. What matters is that it's an amount you can keep going with, without constantly needing to pull it back out. Step 3. Double check your foundations. Do you still have some cash for short-term needs and emergencies? Are you happy with your plan for any high-interest debt? Step 4. Choose the type of investment that matches your risk comfort. For some people, that might be a broad global index fund. For others, it might be something steadier or a mix. The specific choice will depend on your own research, your reading, and possibly professional advice. What you've learned in earlier videos about stocks, risk, inflation, and index funds should help you understand what you're looking at. Step 5. Set up a regular contribution if you can. Many people find it easier to invest a set amount each month automatically, instead of waiting to see what's left over. In the UK, this might be through a pension contribution or a monthly amount into an investment account. Little by little, month after month, you're adding to that basket. It won't feel exciting day to day, but over the years, that steady habit is often what makes the biggest difference. That's the rough process. The final piece is how you think and feel about investing once you've started. Part 5. Expectations and mindset. Starting to invest is one thing. Sticking with it is another. Markets do not move in straight lines. There will be years where things go down, sometimes sharply. You might see headlines about crashes, recessions, or crises. You might hear other people bragging about quick wins with risky bets. In those moments, it's easy to feel like your sensible, slow plan is pointless. This is where mindset matters. If you've set things up so that you are using long-term money, you understand the basic risks, you've chosen diversified, low-cost investments, and you have some cash buffer for life surprises, then a lot of the day-to-day noise becomes easier to ignore. You don't need to check your investments every day. You don't need to react to every headline. A simple rhythm like check in a few times a year, see if anything major has changed in my life, keep going is often enough. You will see your investments move up and down. That is normal. The aim is not to avoid all bumps. The aim is to let time and compounding do most of the heavy lifting, while you quietly keep adding what you can. You don't need a perfect plan. You just need a simple one you actually stick with. Let's quickly recap. Before you invest, it helps to separate short-term life money from long-term future money. Have at least a small buffer and understand any high-interest debts you're dealing with. Then, think honestly about how much risk you can handle, not in theory, but in real life. Most normal investors don't spend their lives picking individual stocks. They use funds, often index funds, that spread money across many companies at once, with an eye on diversification, costs, and time. A simple starting process is decide your goal and time frame. Choose an amount you can invest regularly. Make sure your foundations are in place. Pick investments that match your risk comfort. And, if you can, automate it each month. Finally, remember that investing is a long-term game. There will be ups and downs, but with a calm plan and realistic expectations, you don't need to chase every trend or panic at every dip. If you found this helpful, you can subscribe to Money for People for more simple videos about money, investing, and how it all works. This video is for educational purposes only and is not financial advice.